Welcome to today's video. If you're carrying a 7.5% mortgage, especially a variable rate, this is a direct and guaranteed drain on your wealth, and it can cripple your retirement plans if left unchecked. First, we'll clarify why that rate is so dangerous. Then, we'll compare refinance options versus a HELOC, walk through a step-by-step rate shopping plan, and discuss when using retirement funds to pay off debt might help or harm. Finally, we'll wrap up with practical takeaways and a quick quiz to lock in your understanding. Let's get started. Here's our roadmap. First, we'll quantify why a 7.5% mortgage is a guaranteed loss. Next, we'll contrast refinance versus HELOC so you use the right tools. Then, we'll move into a practical, step-by-step plan to secure a lower rate and avoid fee traps. After that, we'll model the true cost with a break-even framework. Then, we'll discuss the risky decision of tapping retirement accounts. Finally, we'll summarize key actions and test your knowledge with short quizzes. Let's anchor on the core problem. A 7.5% mortgage is a guaranteed, after-fee expense that erodes wealth every month. Unlike the stock market, where returns are uncertain, the interest you pay is certain. If the rate is variable, the risk compounds because your payment can jump without warning. Therefore, reducing this rate is often a higher priority than adding to market investments, especially if you're nearing or in retirement where cash flow stability matters most. This pie chart illustrates how, early in a 30-year loan at 7.5%, the majority of each monthly payment goes to interest rather than principal. In other words, you build equity very slowly at high rates. Consequently, lowering your rate accelerates principal reduction and improves long-term net worth. Next, we'll quantify this guaranteed return from paying down debt. Let's quantify the opportunity. Every dollar of principal you eliminate at 7.5% stops 7.5% interest from accruing. That's a risk-free return, in the sense that it's a cost you no longer pay. In practice, your after-tax cost depends on whether you itemize deductions and how much interest is actually deductible. Many retirees use the standard deduction, which means the mortgage interest might not offer any meaningful tax benefit. As a result, the effective cost often remains close to the sticker rate. For a $400,000 balance at 7.5%, first-year interest is roughly $30,000. If you can refinance that down to around 6.25%, you could save $5,000 to $7,000 or more in interest in the first year alone, depending on the exact amortization schedule and closing date. Next, let's choose the right tool for the job. Here's the key distinction. A standard refinance is typically the right tool for replacing your primary mortgage. It can offer a lower fixed rate over a known term, commonly 15 or 30 years, delivering predictable payments. By contrast, a HELOC is generally best for smaller, short-term financing needs. It's usually variable and can expose you to payment shocks, which is the opposite of what retirees need. In short, for the main mortgage, focus on a refinance, not a HELOC. Next, let's plan how to win the rate game. Here is a practical sequence to secure the best deal. First, call your current lender and request a retention offer. They may lower your rate or reduce fees to keep your business. Next, solicit 3 to 5 quotes from a mix of banks, credit unions, and reputable online lenders. Then, compare the APR and total cost to close. Do not focus solely on the nominal interest rate, because fees can erase the savings. After that, watch for junk fees, avoid excessive points unless the break-even is compelling, and consider whether a float-down option is available if rates fall during underwriting. Furthermore, confirm there's no prepayment penalty and that escrows and third-party fees are sensible. Meanwhile, gather income and asset documentation early to avoid delays. Finally, if rates change before closing, recalculate your break-even to ensure the refinance still makes sense. Let's talk about the total cost. APR incorporates many fees, which makes it a better comparison tool than the rate alone. Two loans with similar rates can have very different costs because of points, origination, and third-party fees. For instance, a 6.375% loan with $9,000 in fees could actually be more expensive than a 6.5% loan with $3,200 in fees. Therefore, compare APRs and cash to close. Additionally, ensure the quotes use identical lock periods and the same assumptions for points and escrows so you're comparing fair offers. Next, we'll quantify break-even so you know when a refinance pays off. Here are sample break-evens. The concept is simple. Divide total closing costs by your estimated monthly savings to estimate how many months it takes to recover costs. For example, $6,000 of costs divided by $300 per month equals about 20 months. If you plan to remain in the home past the break-even period, the refinance likely makes sense. Conversely, if you plan to sell soon, you may not recover the costs. Now, let's test your understanding with a quick quiz. Quiz time. The question is, what should you do before selling investments to pay down a 7.5% mortgage? Option A. Immediately withdraw from retirement accounts to eliminate the mortgage. Option B. First, pressure your current lender and shop multiple refinance quotes. Option C. Open a HELOC to replace your primary mortgage. Option D. Ignore fees and choose the lowest advertised rate. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Before liquidating investments, exhaust your refinance options and negotiate with your current lender. This approach can reduce your payment and interest cost without sacrificing retirement principal. Next, let's examine the high-stakes decision of tapping retirement accounts. This is a pivotal decision. On the plus side, eliminating 7.5% debt produces guaranteed savings and lowers your monthly outflow, which can be emotionally reassuring. However, tapping IRAs can trigger taxable income, potentially bump you into a higher bracket, and even increase Medicare premiums through IRMAA. It also reduces your invested principal and future compounding, which can compromise long-term income. Therefore, consider refinancing first, or use a partial lump sum that keeps you within a tax-efficient range. Next, we'll connect debt and retirement sustainability. In retirement, cash flow stability matters more than chasing uncertain returns. Lowering your fixed mortgage expense increases resilience against market downturns. A fixed-rate refinance can remove variable rate shocks. You can also adopt guardrails, such as maintaining a sustainable withdrawal rate, while still sending modest extra principal payments to accelerate payoff. Finally, remember that today's definition of a good rate is based on current market conditions, not on historical lows. Even a half-point reduction can translate into tens of thousands saved over the life of the loan. Now, a second quick quiz to reinforce these concepts. Here's the question. When might paying down a 7.5% mortgage beat investing extra cash in the market? Option A. When you expect guaranteed 12% stock returns next year. Option B. When you need predictable, risk-free savings and improved cash flow. Option C. When your HELOC rate is fixed for 30 years. Option D. When closing costs exceed the lifetime interest savings. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Paying down a 7.5% mortgage provides a predictable, risk-free return equal to the interest you no longer pay. This can be especially attractive for retirees who value cash flow stability. Of course, always check that closing costs or prepayment penalties don't undermine the benefit. Next, let's crystallize the main ideas. Here are the essentials. First, a 7.5% mortgage steadily erodes wealth, so act quickly to reduce it. Second, for your main mortgage, a standard refinance is typically better than a HELOC. Third, shop aggressively and compare APRs and all-in costs. Fourth, calculate your break-even and ensure you'll own the home long enough to benefit. Fifth, be very careful when considering retirement withdrawals because of taxes and the loss of compounding. Finally, judge rates by current market conditions. Small reductions can yield large lifetime savings. This flowchart maps the path from recognizing a high-rate mortgage to executing a refinance decision. It begins by checking for a lender retention offer, then branches to gathering multiple quotes and comparing APR and total costs. It includes a break-even calculation node to decide if refinancing is worthwhile. There's also an alternate path to consider a partial IRA withdrawal, but that branch requires tax bracket and Medicare premium checks and culminates in consulting a fiduciary advisor. This visual ensures you follow a disciplined process rather than reacting impulsively. To recap, contact your current lender first and then collect multiple quotes. Compare APR, all fees, and total cash to close. Confirm your break-even period and verify there are no prepayment penalties. Lock your rate strategically and ask about float-down options. Avoid tapping retirement accounts unless you have modeled the tax impact and confirm the long-term trade-offs. Finally, stabilize your cash flow and, if possible, add small, extra principal payments to accelerate payoff. Disclaimer: this content is for educational purposes only and is not financial, tax, or legal advice. Your circumstances are unique, and you should consult qualified professionals before making decisions. Mortgage rates, fees, and regulations change over time and vary by location. Always verify the specific terms, costs, and implications for your situation. Thanks for watching. If this video helped you understand how to tackle a high-rate mortgage and protect your retirement, please like the video, share it with someone who needs it, and subscribe for more practical financial strategies. I'd love to hear your refinance wins or questions, so share your thoughts in the comments below.